today we are actually putting in additional effort on tax deduction because we had a lot of you responded to our webinar that we did 2 weeks ago, which is small business deductions you must know, like a common deductions. But there's more questions coming up, so we think that we want to come back again and really give you some, maybe some ideas and refresh your memories, and so you know that what to deduct. Right now it is time, right? You're doing tax return, and if you got good year, you look at the taxes that you're about to pay, then you want to make sure that you actually had deducted everything that legitimate to deduct, and you want to make sure that you don't have corners that blindsided and you just didn't even know. So today we will kind of touch on a couple of these things. For example, paying your children to work for you, and travel expenses, meal, entertainment by per diem, and what did that do to you? So things like that. So let's go ahead, share screen. So I kind of want the PowerPoint to guide our thinking so we can be more efficient in our moving forward within this hour. And of course, I just finished the second book, which is 10 a.m. We're symbolizing growing your business. So 8 a.m. you started, 10 a.m. you grow. And so I'm on to the third book and the fourth book, which is 2 p.m. and 6 p.m. 2 p.m. it is a continuation of growth, but no longer organic, no longer just you grow. It is the time you combine forces. You either merger, acquisition, or sell. So all of these things are part of the growing. And then 6 p.m. I will write about how you retire from your business. So the retirement for you, me, and people who are younger, no longer the same as the parents, how our parents were doing. So how to retire in the new fashion, it is a thing. So I actually, already in my process of working with clients, I put these elements into the book already. So I have a structure I am following. So I hope to roll it out by the time I am ready to retire. So this is kind of, the book is also a journey of my own, and you can tell where we are as a community CPA. We definitely at the growing your business stage, but right now we're into the merger and acquisition because we're looking at, getting other CPA firm to buying other CPA firm and, acquire other businesses. So this is where we are. And so kind of give you an idea of how other people, how business people grow, right? So I'm nothing special, just very typical. And that's how business grow. All right, no responsibility disclaimer, and our corporate attorney wanting us to make sure we speak about it. And, in reality, when you are doing your tax returns, especially those DIY folks, you do it yourself, which is good. But when you learn something on the internet and just go a little deeper or consult with the professionals, get that opinion in writing instead of just Ying told me I'm going to deduct this. Of course, Ying told you. Of course, you can deduct that. But then again, it cannot be used for justify your deductions in case you got audited, right? And because if you do have a reference which is legit reference, then maybe to charge you for calculating that wrong is okay, but the government cannot come back to say you fraudulently make up your taxes. So those kind of criminal charges would never be there because you do have a source of data, source of references coming through. And this is one thing that when I want to mention here, when you call IRS, you know how IRS, the other line, always tell you their ID, and you want to write that down. I will tell you why. And I especially wanting everybody to do that right now because IRS hired a lot of new people in their system. A lot of them are online. So, I will tell you that I have called these numbers. The advices they give me and the answer they give me was not right. It's just wrong. They don't know what they should know. They're new. Or they put you on hold for 2 hours, then the line just dropped, right? So I'm not exaggerating. And when I say 2 hours, it's literally 2 hours. So what I want you to do is when you get those phone calls, write down the ID, because whatever that ID was telling you, you do it according to what it was said. And in case you get audited, that's your gateway to come out without too much of a damage. So make sure that you write down that number. All right, so let's get cracking. And business tax deduction, if I always say that this is a billion-dollar question. It's not even $1 million anymore, because there is no real guidance to give you black and white on what to deduct as a business expense. The IRS word was just ordinary and necessary. So, take it as you can understand. So, obviously it has to be related to business. It need to be ordinary, need to be necessary in order you to deduct. So we're not going to go too much on this, dwell too much on this. I just want you to know that's the guidance from IRS. All right. And then, of course, when you deduct, when can you deduct the expenses? That has a lot of theories behind it. So generally speaking, their timing is actually important. Okay, I want you to understand that if you are cash method accounting, which is like your 1040, okay, your 1040, your personal tax return is always cash method, and you cannot run your personal life on accrual. I'm sorry, who knows, if you run your life on accrual, maybe you will accrue a wife for yourself or something. So the 1040, the personal side of things is all cash. But when you are in business, you can be a accrual method, right? So the timing of when the expenses can be deducted related to your accounting method. So if you are in cash method, just means that whatever come out of your bank, that's your expense. Whatever come into your bank, that's your income. So it is calculated based on when the money landed on your book. Okay, so remember that. But if you're on accrual base, that just means, you could, there's a bill you need to pay in 30 days. But today is December 31st, and you haven't really paid the bill, but can you account that as your expense? If you are under accrual accounting, yes, you bought expense, you bought, you bought materials and the things that, for right now for 2022, but you pay in beginning of 2023, you can still deduct it. So this is why I brought up this when. So when can I deduct an expense? So that largely depends on what kind of accounting method you're using. Okay. All right. So now let's go take a look at cost of goods sold. This is actually this, and by itself just means that when you sold your product and give me the cost, that's basically what it says. So if you didn't sell it, you don't have the cost. If you didn't sell it, so the cost belongs to where? Belongs to inventory. So this part of cost of goods sold only reflected on the merchants you actually sold out. You actually not have it on your hand anymore, then you have a cost of goods sold. Okay, so with that concept, follow my thought. Let's say if you purchase a $5,000 total, okay, and you sold half of them. So your inventory is 2,500 and your cost of goods sold is 2,500. So your cost of goods sold will reduce your sales. It will give you would calculate the net profit for you. And the bigger the cost of goods sold, the less profit you have, right? And the less profit you have, you'll pay less taxes. So as a business owner, you know that when you have a bigger cost of goods sold, your business will make less money. But what if I say, my inventory is huge. I bought $5,000 worth of merchandise, and my cost of goods sold is only $1. Okay, the rest of it is still in inventory. So does inventory help you to pay less taxes? No. The more inventory you have, the more taxes you will pay, because you are holding it back from making that to be a cost goods sold for yourself, right? So in my example, you bought $5,000 worth of good in 1 year. You only have $1 in cost of goods sold. So your sales minus that $1, that's your gross profit. But you have $4,999 sitting in the inventory. That would not do any good for you, because it is not impacting your bottom line. So to make it simple, I want you to just close your eyes and remember, higher the inventory, the more taxes you pay. Higher of cost of goods sold, the less taxes you pay, because they are not the same thing, even though they're so related. So that is the cost of goods sold. I want you to reconsider your cost of goods sold. If you made a lot of money in 2022, you're paying a lot of taxes, you're not sure about your cost of goods sold is right or wrong, and this is the time to really look at whether you have included everything in the cost of goods sold. There is a webinar we have done in the past on YouTube. If you type into cost of goods sold, you'll find them. It is right here listed on youtube.b, this one, and you can go take a look, and making sure that you have made the cost of goods sold number correctly, not confuse that with inventory. All right. The other expenses, and often you will see, it is related to when you get into the business. And I have a client come to me, and he started up a lawn mowing business, and in the summer. So he was doing that just, casually and here and there for the relatives. So he didn't really think that was a business. So then this summer he decided, okay, this is the business. I'm going to advertise and doing more lawn mowing. So he started up the business. When you start up a business and you have an opportunity, and to treat some of the expenses you had before your business began and take that in as your expense. So don't forget that, because this gentleman who started lawn mowing business, he already have like 3-4 lawnmowers of his own. He just started the business, but still using the same equipment. But he forgot those lawnmowers are actually now from personal property becoming a business property. So that can be a cost to deduct. So you can see that if you have $50,000 worth of business startup cost, when you bring in to be the first year business expense, you would amortize that by 10 years, it says. So you deduct $5,000. So you can take that, you can add up all of these startup costs and to start depreciating and start deducting them in your first year tax return for your business. Just remember that is one thing to do, right? It is something that very easy to be forgotten. Then, of course, a lot of people goes hire children. I want to hire my children. I'm just, I tell you that's such a bad idea. If you want to be really disappointed with your child, you hire them to work for you, okay? That is for sure the remedy for mom or dad to be dissatisfied. So, it is a bad idea. Quote, but for taxes, may not, okay? It just emotionally, you got to deal with this. And then have your child working for you? Oh my goodness, that is so hard. Okay, if your child is less than 18 years old, so there is no age limit, you can hire your child, okay? And, even if you can figure out a business reason for you to hire your 1-year-old, and you hire. And hiring your kid who is under 18 years old, it is almost like hiring a subcontractor, because you don't need to withhold Social Security, Medicare. They're your kid, And if you run sole proprietorship and a partnership, a husband and wife is in the LLC, absolutely not. But I would not recommend the other corporations to hire your little child. Corporation is corporation. So when you hire your child, and you still need to think of they are your employee, or they are your subcontractors, just like how you run a normal business. Just because of your child, so it doesn't subject to the labor laws. So you're not going to be penalized by DOL for utilizing underage children. However, and you do have to consider reasonable, right? Reasonable, and that is the magic word for all the deduction. Of course, if you normally pay $11 on this type of clerical work, but because this is your child, so you do $30, that's not reasonable. And IRS could come back to challenge your position unless you have a special reasons why that is the case, right? So under age 18, you don't deal with Social Security, Medicare because they're exempted anyway. They're younger, but you still need a business reason. You still need to know what you pay for your children. And if you're running a corporation, I would still have you run them on the payroll because you don't have to worry about them paying Social Security, Medicare. Okay, they're underage. So if they are more than 18 years old, there's a lot more to consider. Okay, and you want to, you definitely don't want to spoil your child like they're doing nothing but you're paying a lot. And those are bad ideas for you. And it's also not a good way to bring up the children. I know it is easy for me to say, it is hard for business owners to do. In my second book, I actually write about this kind of thing. I have a client eventually closed down the business because she hires one of her adult child to come to work at the business. Man, that child come and go as he wanted, and it really destroyed the culture of the business. Eventually, the employees were acting the same way, so he closed the business. So with that said, that's a different consideration. But here, if your children is more than 18 years old, obviously, our deduction, our personal deduction is $12,950 for 2022. That means if you pay wages of $12,950 to your child, to your grown-up child, they're not paying tax. They're not paying income tax at all. Okay, so yeah, if you pay a lot of taxes because you make too much money, then you want to run this money into your child because they work for you. Absolutely. This is the tax strategy that you can plan out, and your children can be paid even more. Then you can help them to save to retirement, and you can help them to, get trade a specific training, send them to conference and get them beefed up with knowledge. And there's a lot of things you can do for your adult child. But what you want to remember is whatever you do for them, it will affect them personally, because when they apply for college, and the financial aid might not give them any money because they make money already at your company. So just be aware of any money you give to them under their name, and it is going to become their asset. If your kids are bad kids, they're dealing drugs and things out there, and the money you give to them under their name is theirs, they can spend any way they want it, so you don't have much of a control. But in terms of income tax concern, of course, if you give money to a lower tax bracket, you make it, you save taxes. All right. So this is an area that we get a lot of questions, but it's really not a cookie cutter answers for you. Depends on your family situation, depends on how your business is, what kind of business you're running, and it may or may not even be able to bring your children into. But if you really do want to plan your children into your tax saving strategy, it is really worthwhile to hire professionals, hire community CPA to do a tax planning for you. Then bring all the children in, even if they're married, they're adult children, and you can still plan. So there's so much more you can do related to children. Just know that even if they even as long as you want to deduct that as a business expense, you need to find a business reason to do so. And you cannot just because they're my children, so I pay them any way I want it. You still need to have some benchmark to make sure that it's reasonable. All right. Automobile deduction. This is the one that a lot of folks really liked the way we talked about this. So let me just kind of hone into this chart again, because this was the chart we used last time. And when you are running business, your vehicle, it is either business vehicle or personal vehicle. The reason I say that, the vehicle has titles, right? So it depends on what title that's under. So that belongs to whichever category. So let's say you bought a new vehicle, you have the company name on it as a title, and you also have your personal name on it as a title. That's fine. So we can take that vehicle into business. So this is a business vehicle. So it's almost treated like asset in your business, like the equipment, like a machine, like anything you own in the business. So it's listed as a business asset. Then from there, maintaining the car gas, and things like that, and depreciation, all of this going out of the business side of the book. If you want to use business vehicles for your personal purposes, then you need to reimburse the business for using business vehicle for personal purposes. All right. That on this chart is just your left-hand side of it, and that's the business side. But on the personal side of vehicle use, so this is my personal vehicle, my personal name on it, the insurance is under my family's umbrella, and it is a personal insurance. So everything is personal. However, I use that for business. Then you have two ways to claim it. One way is standard mileage deduction. The other one is actual expense deduction. The standard mileage deduction and actual, the only differences between the two is that if you have the actual method, then you just keep your receipt, right? You keep your gas receipt, you keep your car wash, you keep your repair, you keep insurance, you keep all the receipts. Then you calculate how much was used for business, how much was used for personal, then the percentage of business times all of these expenses, you know how much to deduct. So that is the actual method. Then if you don't do actual method, you want to do mileage, that's really simple as well. You need to put in a piece of paper with 5 items. Let me say these 5 items. You must document every trip you made for business with 5 things in mind. Number 1, the date. When did you do it? Number 2, where you start driving, the address. Number 3, where do you go? The address. Okay, where are you going? So that's number 3. Number 4, purpose. Why are you doing that? Number 5, the mileage. It is not a mileage that you go on Google Map and figure it out, because I know you never drive the same miles as what Google Maps says, because a person like me, I get lost a million times. So I always drive literally a lot more miles than what Google Drive says. I don't know how Google Drive does. I think the Google Drive miles are calculated based on you on this one lane without going anywhere and straight point to point with these one lane with no alternatives. But in reality, we switch lanes, we get lost, we come back, and God knows what we do on the way there. So we got more mileage. So my point is that you need to have that documented every time you do the trip. Not good idea when IRS auditor come, you go like, oh, let me just calculate that for you. I didn't have it, but I can make it up right now for you. And it is not illegal. You are allowed to come up with reconstructed mileage log, but it's not very convincing for IRS auditor to feel that you are, diligently being accurate about your deduction. You know how important that is when you are in audit. You want to impress the auditor to have him see that you're sincere, you're honest, and you're doing the deductions is all by the book, and that would be the best outcome, right? And trust me, your record would not lie. If you are that kind of person, it will show. Even if you made a mistake, IRS auditors would go pretty easy on you because they know that you are doing a good job. But if you are just everything is after fact, you made up, you came up, maybe you didn't lie, maybe that's still right, but it just doesn't really ring very well with IRS auditors, right? You understand what I'm talking about. So that is the standard mileage, the 5 items that you need to come up, and no more, no less. You have to have it. We call that handful proofs, right? Handful proofs. You have to have handful proofs for your standard mileage rate deduction. All right. So with that said, I already explained to you, I just want to show you about the mileage in 2022. It's a little tricky because you have to split your mileage between the January to the end of June, then July to December, because the rates are different, right? Therefore, there are 4 cents more per mile, and for the medical and the moving rate and the business rate, 62.5. Never so high before. So that was that's something I want you to know. For 2022 mileage calculation, you need a little bit of effort, a little bit more effort. Other than the handful proof, you also need to calculate the rate differently. So I always say that if you can get away from doing standard mileage deduction, get away from it, because it requires so much administrative work. Hardly worth it. If you are a busy entrepreneur and don't spend your time on that and trying to get your car and go get your car under the business title and run your car into the business. And if you're like me, working 24/7, and I don't really have a lot of personal miles. Where did I go personal? I mean, I only just running between the branches, right? So then you actually don't need to reimburse the company for your personal miles. So that would be why you are having a company vehicle instead of reimbursing yourself on mileage. All right. So this is, I kind of covered that, my dear. And then, just need to know that one thing I want to tell, 2 things. So on the standard mileage rate, you cannot have more than 5 cars, okay? And if you have more than 5 cars, I think you're running a taxi fleet. You probably should change your business model to begin with. So you're limited to less than 5 cars and to do the mileage claim. And also, if you have done the mileage already on this car for the first year, you can switch between the actual and the mileage like that. Once is mileage, is forever mileage. Once is actual, forever actual. So you may ask me, oh, Ying, after I hear you, I don't want to do this standard mileage deduction anymore. I want to, sell my car to the business, upgrade the title, the title, so the car belongs to the business. But how am I going to do that? That you need to go through that transaction. So just like you said, you can sell your car to the business and then upgrade the title. That is what we call the triggering event. When you have a triggering event, and you can change that. But for the same car, without triggering event, you cannot switch method. In the middle of the century. No, you just have to have a triggering event or sell your car, get a new car, and then start doing something different. All right. Okay, business meals. And this one we covered, but folks are still having questions related to this. So I want to say that for 2022, we are doing taxes for 2022, folks, right? So for 2022, the business meals, the business meals can be deducted 100%. There's no 50% of rule like you used to see. So just make sure that you are aware of that one-time change. But back in 2023, you have that 50% again. So just make sure that the business meals is different. When we say business meals, folks, and we're not talking about every meals. We're talking about the meals that triggered by business needs. For example, you need to meet with your employee, you need to meet with these potential suppliers, and you need to meet with people who are potential buyers of your business. Those are business meals. And I just want you to kind of understand, you still have to attach a business reason for eating for that expense to be deducted 100%. All right. And then, of course, we always have questions related to the employee's meal expense. And that they are jobs require employee to work throughout their meal time. And when that happens, the employer provide those meals at a job, and those are business expenses, and it is not something that subject to 50% deductible. So you write off as a business, and then employee can continue to work. But there's also talk about, generally speaking, if you furnish meals to your employees, there's 50% of cost that only 50% you can deduct. So, of course, if you are just wanting to be generous and, providing, meals for employee without a business reason, it's more of an entertainment reason. And then for 2023, and for sure, these are 50%. They're not 100% deductible anymore, okay? And then with the entertainment expenses, one thing I want you to remember is if the entertainment itself is open to the public or open to all your clients, and that's where that can be deductible. That is 100% deducted because it is part of your, almost like your marketing efforts to grow your business. But if the entertainment is only to say you want to buy this football ticket for certain people in your firm to reward them, unless they are included in their payroll as part of the pay, you cannot deduct that 100%. So those are the rules related to entertainment. So the key for that to be deducted 100%, it is more of to open up to public, to be available to all the other people. So becoming a community efforts and marketing event. So that's where that can be deducted. Home office deduction, that is something brought up again and again by folks, and the people don't really know because they heard of 1,500. Then they were like, okay, I have 1,500. Can I still deduct what? So remember that 1,500 is a $5 times 300 square footage. That is a calculation for you to identify how many footage you have at your house that you use for business. If it is over 300 square footage, forget it. The maximum you can do is 300. But if it is less than 300, you can't use 300. So that 1,500, a standard way deduction that allows you to use the mortgage interest, to use the property tax amount, full amount in your Schedule A again. So you don't get affected by using the other numbers into Schedule A. But if you want to deduct the business on real expenses by percentage of your occupancy for business, then these are the items I show you in front of you: mortgage interest, insurance, utility, repairs, maintenance, and the depreciation of certain office furnitures, apartment rent. If you don't have a house, you have apartment rent, and those are deductible by percentage of usage. So let's say if you rent apartment for $800 a month, and that's the only money you pay for your occupancy, and you use the apartment 50% for business, and then your $400 that can be deducted. So that's your business expense. Does that make sense? So here I quickly, we have a home office deduction webinar that you can check on that. This simplified method, this is the 300 square footage with $5 per square footage calculation I was talking about. Schedule A, you can deduct the full amount of mortgage interest and the real estate taxes, right? And then of course, the other method is really calculating details and then do a percentage of office use. So these are something consider for your deduction. If you felt like, oh, I'm not sure which one is better, then you calculate both. All right. So travel expense. So I know this is not a new topic, but I kind of want to bring a concept in for you related to the travel expense. You know, when you have travels that your employee would do, and you know, as a business owner, you can reimburse them by number one, by their actual expense, right? If they eat outside, and a hotel, I bet you already booked that for them. So they have hotel incidental expenses they want you to reimburse. So you can reimburse by actual that expense. And you can also reimburse your employee by what we call the per diem. Okay, so you can calculate both to see which one is more beneficial for deduction, especially if you are self-employed business owner and you run your own shop and you need to go to Vietnam and for business trip. And is your business trip actual expenses is bigger, or is your per diem is bigger? And so you can literally calculate that yourself, then decide on which one to use for tax deduction. So that is what I want to offer you to reconsider that, especially if you're running a truck driving company and you are truck drivers and you have your own company, and really consider per diem as an opportunity for you to deduct, so you're not strangled by every receipt and everything, and you just report your days and when you are out and where did you go, so you can come up with the expense. You can come up with a per diem number as a expense, so you can write the check to yourself, a non-taxable on you personal end, but for business that is a deduction. So a couple of key points I want to mention here. Per diem is not considered wages by IRS. So let's say if you are employee of Community CPA and the Community CPA writes you a check, per diem reimbursement, don't report that on your W-2. Is not considered wages. Employee does not pay taxes on per diem payment. And the employer, Community CPA, the company, can deduct it as a business expense. If your per diem is higher than federal limit, okay, this is important to know. Let's say as a company, your per diem rate is higher than federal limit, then the remaining amount is taxable to employees. So let's say the federal limit is 160 per day, but your per diem is 200. So one employee claimed 200 from you, and they had a $40 taxable income. Does that make sense? So, but for you, you still deduct 200 because that's what you paid to your employee as a per diem. So, what I'm trying to say is that per diem is deductible for the business owner, and no matter what you give to the employee. But for employee, if it is over the federal limit, the employee has liability obligations to pay for that additional taxes on the extra amount. Employee must file expense report to claim per diem. So as a business owner, don't try to save time and, oh, I know that he went for 10 days. Let's just write a check, 10 days business with no expense report. No, you still need an expense report. You need to put in the expenses, the receipt you have, even though it is not enough compared to the per diem, but you still want to include that. Company does not have to pay per diem to employees. You can stay on actual reimbursement, okay? So as a business owner, you are not obligated to do per diem. But if you are the only employee for your company, so you're gonna measure which one is bigger for you as a tax deduction, okay? So that's where I'm trying to drive that flexibility to you, and it's totally allowed, it is supported, right? People do that. employee does not return unused per diem. So if I am an employee of Community CPA and I got a reimbursement, I got per diem reimbursement, I actually didn't really spend that much. And I got a little extra. As long as not over the federal limit, that's yours to keep. You don't need to return to Community CPA. Okay, so where to find the per diem rate? I know that is your question. So IRS publication 1542 is where you're going to find. So the best practice for small business owners, listen up. Consider using per diem rate for your traveling, which might yield more tax deductions. Example, actual expenses for 10 days business trip is 1,150. I spend a hotel and I eat, a couple meals. I didn't pay for it because my client paid for it. So total 1,150. Per diem standard rate is 160 per day. Okay, this is a federal rate, federal limit, and for within US. So 160 times 10, I have 1,600. I can write a per diem reimbursement check back to the employee for 1,600. The employee don't need to pay any taxes, reimbursement, and the business can deduct what? 1,600, not 1,150. Makes sense? So that is where we want to land today's topic for traveling. Depreciation. Folks, I want to clarify one item with all of you. So you heard of bonus depreciation, right? So good. And you spend all the money and you can write off all the money in one shot. You don't have to depreciate that with your lease term years and years. And so this is great. What's the difference between section 179 and bonus depreciation? So that is a most frequent asked questions when our clients are considering what kind of depreciation they're taking. So let me just help you to remember one thing. Depreciation by 179 section cannot create losses for you. Yeah, you can still deduct all of your expenses. Say you did a $250,000 renovation. Under 179, you can deduct a 250,000 if your profit is 250,000, because it cannot create a loss. It can offset your profit. But bonus depreciation can go beyond that. So you did 250,000 renovation and you apply bonus depreciation in 2022, you write off 250,000. That 250,000 can create $250,000 losses for you. So if you are 1120S, you got a K1, then this will be a K1 negative, right? And you can bring that into your 1040. Maybe you have a W-2 job or your spouse has a W-2 job, that is 250,000. There you go. The negative K1 would offset your W-2. Then you don't pay any taxes this year. All right. So that is the key difference. So depends. We have seen business owner got their tax done somewhere else and they were using 179 and never ever deduct anything because they were running losses the past couple of years, and so it was just hiding behind. No, you don't want to do that. You want to understand which depreciation would generate impact for you in this year, and don't push them out to the future years. I always say that, only financial planners are futuristic thinking people, and your tax people should be present. Your tax people should be those kind of Alcott trolley kind of people and only focus on power of present. Okay, so we want to make sure the deduction coming in now, not later. So this is the general depreciation. And I also want to mention to you that when you do depreciation, because it is depreciation goes on several years, even though you deducted in 1 year fast, but your normal years is 5 years, so your asset is still staying on your balance sheet. Depreciation is the item that if you get audited, the auditors can go back to many years to follow your depreciation, to look at when did you buy it, and give me a receipt from 2000. You may say that, well, no, there's a statutory limitation. They can go over 3 years. Not for depreciation. They can go back for many years to track you down. Business bad debt, very important. And you know that especially if you are in business where your client would pay you and you have this account receivable you're holding, and you look at every month to see who paid you, who still owe you, and those who didn't pay you, and you're like, I'm not sure they're gonna ever pay me, and I probably lost this already, I don't really know. And in, you know, in construction business, you know how they have a retainage, so this retainage maybe never going to become your income because they that your job quality was so bad and the customer are not happy, they refuse to pay you, so you at that time would end up with something that you think you're going to get but you didn't, right? So if you account your income already for those receivable, because there's a cash accounting, accrual accounting. If you are on accrual accounting, you already pay taxes on those income that you didn't get, because it is already accrued into the tax return, pay taxes. So in this case, you have a bad debt. But if you're cash accounting folks, you only reported income for what you received. So you should not have bad debt. Why? Because you didn't receive it, you won't pay taxes. So it is not like everybody would have bad debt. Only existed when you are accounting income by accrued method. Makes sense, right? So someone said that, oh, Ying, how much can I deduct bad debt? there is no threshold on this one. And my going back to you is, how much did you lose? You know, so 100% deductible. And sometimes the management, like the business owner, will decide maybe, you know, only 90% of it is not collectible, then they deduct 90%. And, you know, they make management decision on that deduction. So many years ago when I was at Wells Fargo, you know, you also have this accrual on the bad debt for, of course, big companies like that, they're on accrual method, they're using GAAP standards for their financials. So, you know, the management has to put their heads together to decide whether what is the write-off. Is that 12%, 16%? Depends on the economy, depends on the experience they have from last quarter or the quarter from last year. So to decide on those ratios. So these are subjective deductions in some way, but you can definitely consider that to be deduction. If you loan the money to somebody and then this person doesn't come back to you, and you, when you loan this money, you put that on the balance sheet as a, you know, as a loan to someone, you're supposed to receive it back. If you lost it, and that is a deduction as well. Okay, so make sure loan, business loan and the credit sales to customer, those are all possible bad debt that you would incur. All right, we're almost at the end. Others to consider. What others to consider for tax deduction? Remember, this whole reasons you are here, because we're throwing at you with all kind of ideas of what you can do to reduce your tax liability, tax deductions. And I would still tell you that, you know, as much as tax deduction is so attractive, and you really requires the business owner to plan. If you plan properly, deduction will come to you and you will reduce your tax properly. And the last minute, the imagination of tax deduction is not recommended, and you do not want to do that. And these couple of expenses are the one that we want to talk to you. So for example, business expense on retirement plans. And if you already made profit, and what is stopping you to put retirement plan in place so that can be your tax deduction? Do you know that as a business owner, every year, like someone who is more than 50 years old, like myself, and your maximum 401k deduction can go up to 67,000 a year. If I made 67,000 profit, and but I do this retirement plan, maximize it, and I had a 67,000 going away as a tax deduction, my profit is what? 0. So I don't need to pay taxes. So these are the things you want to consider. They are beneficial and they're legitimate. And do you know that retirement plan is so protected, even if you have creditors who are after your tails and thinking that are suing you, your retirement money in the retirement plan is protected. They cannot get that to you. So as a business owner, that should be your number one priority, to start beefing up your retirement plan. Okay. And especially we live such a happy life. We're gonna live forever. And you know what you're gonna do if you get old and you have no money. So no, that's doesn't sound very good. So make sure you start doing a retirement plan as a priority for yourself. Okay. And rent expense. Rent expense, it is always a legitimate expense as long as it's business renting it. So sometimes we see a lot. Sometimes the business is running in the building, but the building is actually belongs to the business owner themselves. So what you do is the business will pay rent to the business owner's building, and that rent is expense. So in general, you want to make sure that the rent is a reasonable rent for your area. And because it is your own property, so you want to increase rent and the reduce rent any way you want it. That's a not good practice. You want to have a lease agreement and follow through what you pay. And that really shows the integrity of your business transaction. So IRS not going to come back and goes, well, that's not an arm's length transaction. I'll deny you. And it can be a can of worms if that rent expense is not being set up as a proper business transaction. So when you run business, you maybe borrow money from people. Maybe you borrow money from your mom, and you imagine that you can pay your mom interest expense, so your mom can claim that income, and maybe your mom is not making a lot of money, so those interests would not really make any dent on her tax liability. But for your business, you can deduct that as your business expense, right? And make sure that for taxes, you don't just think of income tax. And a lot of times there are local taxes, there are property taxes, and the taxes of different kind that all come into play. So make sure you captured all of them. Insurance as well. There's so many insurance. You have a liability insurance for general business. You have a liability insurance for practice. You have, workers' comp. All of these are insurance, and just don't got them so messed up you don't even know what insurance you are deducting, and making sure you have all of the insurances. Generally speaking, for any businesses, you at least should have 3 insurance. Do you know which 3? Vehicle and general business liability insurance, workers' comp. So those are general 3. And you can't get away from these 3, can you? Unless you don't need to drive for your business. All right. We are almost done, my dear. So now, question on other deductions. If you have any questions related to business deduction, and Community CPA is your resources. Earlier, before we start the conversation, I showed you where to go on our website. You can book our appointment. Those appointments, of course, is a paid service, and you go on booking, then you can pay right there. Then the time will be secured on our calendar. Actually, when you book my time, I actually get an email saying, hey, you're famous, getting booked again. So it's kind of like a fun message to me, and knowing that, oh yeah, you need me. So I get a lot of these type of bookings, and it is on our website, and we welcome you to ask questions. And that's really it for Saturday. Our YouTube channel is always there. And Catherine at communitycpa.com, she is the master of our webinar management. So if you have questions, you can send to her directly, and she'll make sure I get ready to speak about it. And our goal here is to provide free knowledge for people who wants to learn. And in United States of America, If you want to become a successful business owner, there's only one way to do it, to gain the knowledge and play the game. And if you don't know, and then you don't know. But if you know and you diligently processing it, getting it to your possession, then you can win the game. I'll talk to you again and see you Tuesday. Bye-bye.